Good morning. Thank you all for joining us this morning. I have with me Brian Gibbs from CAPIS and Carrie Richardsville from Mariner for a discussion on TM. Let's jump right in with Brian Gibbs. Brian, give us a little bit of background, uh, your background with TM and how you come to this space.
Sure. So I actually started here at CAPIS as an intern in 2002, and I have actually been working with transition management since January of 2003. So over 20 years of experience being able to help clients with their asset allocation restructurings and kind of seen it all.
Great. Thank you, Brian. Carrie, same question. Your
You got it.
background
Good
on
morning.
transition management.
Good morning, everyone. So just kind of by way of background in my career, I am an institutional investment consultant. I've been in this space for about 9 years and with the same firm for that same period of time. Before that, did kind of some in-house investment management and kind of manager of managers types of work. Also started in 2002, Brian. So that's a fun fact. We kind of got our start right around the same time. My introduction to transition management came when I joined my current firm in 2016. I actually think one of the first meetings I took was with a transition manager and some of my colleagues. And that was really my introduction to the concept of transition management. Made a lot of sense. Never really thought about when you fully terminate a manager, is that kind of best execution really there? And some of the delays that can come with asking a manager to liquidate their portfolio and not using a transition manager to kind of help line up the whole thing and maybe get some efficiency that way. So my first introduction to transition management, again, was at the very start of my consulting career 9 years ago. And I've used it, I mean, from the beginning several times since for a lot of different reasons.
Thank you. Well, let's stay with you. Let's talk a little bit about the pre-trade considerations, things that you look at before you decide to hire a transition manager. What are the important characteristics to you?
So I would say, typically size, looking for a transaction somewhere maybe around kind of 5 million or north of that to make sort of the behind the scenes logistics, the contracts, all that kind of thing sort of worth it. Certainly asset classes matter too. Some are more liquid than others. So I think really kind of those considerations are typically the main ones for me. But then also kind of the steps involved. What parties are involved? Are we kind of reaching out to an attorney? Do we need contract negotiations for the transition? If we're giving CAPIS kind of a first look or a transition manager a first look to sort of, look through what they might be transitioning and to be able to better estimate what that's going to look like, maybe there's an NDA involved, kind of facilitating that. Very important piece, working with the custodian that is involved in kind of the legacy and target portfolios, understanding their processes. Are there unique processes for a transition event? Does that come with additional paperwork considerations, et cetera? So kind of putting together both the kind of characteristics of the trade and what is required, kind of doing all of that sort of analysis and kind of putting it all together to determine that it makes sense to move forward with a transition manager.
Well, looking at today's volatility, and it's not what it was in 2020, 2021, but it still spikes at times. Do market conditions seem to matter pre-trade when you're considering an event?
Say absolutely. Absolutely, they do. More likely to use a transition manager in volatile markets, maybe even if the size kind of goes below what I mentioned. And I think a good example is I had a client who was moving from partially moving from active management to passive management in their domestic equity portfolio. And this was in February of 2020. So we were kind of right in the thick of it with COVID. And they were buying pretty small pieces of two passive index funds, about 2.8 million in a value and a growth index fund. Typically, that was something I probably would just kind of have the manager liquidate and buy, but due to the volatility, said, we're not taking the chance of kind of major market moves and getting burned by those. So brought in transition management, actually was able to do a special arrangement with the index fund provider that allowed us to place the buy for the index funds on the same day we were kind of transacting out of the active manager securities. And I believe was a much better outcome for that client in the face of that type of volatility to take that type of approach. So absolutely paying attention to market conditions when making those transition management types of decisions.
Brian, to you on that topic, if the market is as volatile as we've seen recently with some of the tariff moves, what can you do to minimize risk in the course of an event? Anything different?
Sure. I think touching on the volatility aspect, I think Carrie brings up a good point too, is she's bringing up some smaller size events. So first off, that just shows you, like, no matter what the size of the event, usually there's a value add for a transition manager to come in, because that money is just as important to a plan, no matter what size they are. So just to make sure that everything is being done in the best possible way with their interests in mind. So, but on the volatility side, we have seen the VIX spike a little bit. We saw it in the back half of December. We also saw it in the front part of March. And so volatility, you would think, would really impact most the opportunity cost risk part of an event. And that is true. Right, as markets become more volatile, the standard deviation bands are going to widen on around the cost estimate and the mean cost estimate. And so that's going to stress the importance of making sure you mimic the target portfolio as best you can, right? We want to snap our fingers. We want to be in the target, immediately, but we know that's not possible for most events. So the things that we can do to look like the target will help mitigate a lot of that risk. We want to maintain market exposure. We want to look like the sectors of the target. One of the examples I always use is, if the legacy portfolio owns, Home Depot, and the target wants Lowe's, you're not at a big rush to really need to move from Home Depot to Lowe's. You want to just maintain that level of exposure relative to what the target portfolio wants. So, and then you can sell and buy in lockstep just to maintain that exposure. That way, if there's any big market moves or sector moves out there, then you're not really at risk to get hammered by those. But really, what volatility can also do is it changes market impact. Volatility and volume, right? So how illiquid a position is are the two main components with market impact. But if you take a small cap portfolio, you set them all to where the positions are about 20% of ADV, and then you change the historical volatility from 20 to 60, you actually see a jump from 35 basis points of estimated cost to about 45 basis points of estimated cost. So again, that just then tells you we're trying to move as fast as we can, but we also have the limitation of we just can't go out there and pressure these positions also. So we're using a myriad of techniques to try to limit our footprint in the market, whether it's using dark pools, changing venues, things to disguise what we're doing.
Now, does your thought process change with larger events? Because I know that you can talk about a $5 million event, but you can talk also about a $5 billion event. Does the process change pre-trade in considering strategies and trading approach?
Yeah, so I guess when it comes to preparing, for a transition event, and Carrie can comment on this too. I think some of the most important steps, they don't really change no matter the size, right? I think if you want to put them in 3 different buckets, you're looking at goals and time frame. So that's the initial discussion. Then you're looking at the pre-trade analysis, and then you're looking at having communication with all parties, right? So goals and time frame, I think that's self-explanatory. What is the client looking to do? Are there any limitations on, we need to start by this date, or we need to end by this date? That can even determine how we want to set benchmarks, which we can talk about here later. The pre-trade analysis can identify any of those problem areas, any risks. For instance, if there's something really illiquid and we're limited on time, that's something that we can discuss, having the outgoing manager reduce those positions so that we can achieve the transition of the time allotted. And then finally, communication with all parties. We might have a great plan, but then find out that something's not feasible because we talk about it with the custodian and the managers. And so that's really key, because just as much as we want to focus on the trading aspect of an event, the operational part of before and after to get everything done and done smoothly is just as key.
Carrie, I see you nodding. What would you add to that?
I mean, I think completely agree with everything Brian said. And there's just a lot, back to our earlier comments about getting the right parties involved. Typically, we'll do a pretty detailed checklist and, kind of backing into, T minus X number of days, what contracts do we need? What notifications should have been made? What authorized signers should have been shared? When is the certified list coming in? There's a lot of details and a lot of kind of operational considerations. I think, getting that right and having all the parties on the same page is absolutely critical to getting to trade date and being ready to go. You don't want some operational detail to kind of hang you up and kind of impede your ability to trade.
So the trading process itself, we can talk a little bit about that. Brian, you mentioned getting sector exposure, market exposure in line. Is that the primary focus? What about speed? How do you balance speed and exposure objectives?
Yeah, I think we always have a plan going into trading, but we have to be adaptable, right? There's a reason that you don't want any transition manager just to maybe talk about the event, have the strategy discussions, and then pass that off to another trading desk, or even a different division, to where some of that strategy can maybe get lost. But even then, there's a lot of having to adapt to what the market does, right? We're trying to find liquidity, we're trying to find crosses, and so the pacing is dictated by how well we can find volume. So and we're looking at what's happening within the portfolio, how they're moving against each other. We've identified some of the items that are outliers. Maybe we can get perfectly neutral relative to the sectors and the weights of what the target manager wants, but there might be a position in the target that has, or the legacy that has just really horrible correlation to the sector in general. So we're trying to identify those and trade those as quick as we can as well. Yeah, I think from what you've mentioned, we're trying to be market neutral and then sector neutral, and then focus on the individual outliers. That's kind of the top-down approach in simplistic terms of how we view most events.
Before we get into benchmarks in the post-trade side, are there any particular things in the pre-trade analysis that you think are helpful? Is it mainly explicit costs, or are you also looking at the implicit costs for a trade? What do you look at on the pre-trade side?
So I definitely look at both implicit and explicit costs just for kind of the setting of expectations. I think with a lot of my clients, a lot of my book is public pension, kind of firefighter and police pension funds that typically meet quarterly. So they don't necessarily see kind of the pre-trade before we execute. They typically will see kind of the pre and post-trade after the fact. But for me, it's just, certainly commissions are agreed upon in advance. Those are known. Curious to sort of see estimates for the implicit costs as well, because that sort of sets the stage for, what do we expect? And then kind of seeing, post-trade, how did things shake out? Were they pretty close? Was something, maybe there was a little bit of a difference there, and understanding why. I think doing that over time just kind of reinforces, trust in a relationship with a transition manager, that you're getting good data, setting good expectations. If something changes, that may happen. Is there a good, understandable kind of explanation for it? So I'm kind of circling back to pre-trade. I'm looking at both. I think, some clients, depending upon their level of sophistication, that explicit cost is the easiest to understand. But as a fiduciary and somebody that has a little bit more knowledge, I'm truly looking at both for that expectation setting and the ability to ask a question if something seems a little off, or I'm curious and want more information.
So with an expectation set, then we have to go to what's the benchmark for comparison, right? So if an event's expected to cost 20 basis points versus what? versus legacy portfolio value versus previous day's close, open, market on close. What are the benchmarks that you generally look at in the post trade?
Yeah, so I would say coming up with trading strategy on the front end, we tend to agree on which make the most sense for the approach that we're taking. A lot of what I've done recently with transition managers has been, particularly within domestic equity, as I previously alluded to, going from active to passive, typically, which is a separate account manager and individually held securities, moving to maybe an index fund. And in those types of transitions, we've used market on close. It has made sense to do that because we have typically kind of executed those sells for the individual securities right at the end of the trading day to line up with where we're buying in, at the end of the day for the mutual funds. And so we've used market on close for those types of transactions quite a bit. But again, definitely depends on the event. I have a healthcare client that has a particular holding in a small cap stock that's a healthcare kind of technology related investment. And again, small cap, somewhat illiquid, in an event like that, you might look at something more like volume weighted average price, making sure you're really paying attention to impact. So I think it definitely depends event by event, what is happening, kind of how you're trying to achieve it, what your time frame is. In any given situation, the benchmarks we look at may be different.
On those market on close, I assume that T+2 to T+1 was helpful because you no
Was,
longer need to short settle.
That's exactly right. And or in some situations, we had the ability to work with mutual fund companies under special arrangements, special contracts, to do these confirmed purchases where maybe we're able to submit the buy the same day that we're selling securities. But that was certainly an extra step that was not guaranteed. And we've seen in some events since we went to T+1, the need to do those in a couple of cases has gone away, which is a really nice kind of administrative and operational, development. That's one less step, and it's a big step typically to making sure we stay in the market. We don't need necessarily those extra agreements and steps anymore, which has been incredibly helpful.
Well, we'll stick on the market on close topic for a minute. Brian, I know that you look at market on close and have some kind of limitations that you might not do a certain amount of volume on the close. Where would you consider a trade kind of eligible for, if you will, a market on close event?
Sure, I think this benchmarking is really important. So, you can put a very large amount of percent of ADV on the close and be the benchmark, right? You can show zero implicit cost if you shove something out there because you will get the closing print. So, we tend to be pretty conservative on that. 5% is roughly the number. We look at historic context of what these positions
5% of what? What do you 5%?
5% of the typical close volume for a name. Yeah. So, but we don't want to go over there, especially if we're using market on close as the benchmark, right? Because again, we want to be transparent. We want to be doing what the client wants and something that makes sense. But if something's more liquid than that, then we're usually trading ahead of the close a little bit. And yeah, we're just cognizant of any benchmark that can be gained. I think the benchmarking conversation is really an intriguing one to kind of unravel.
For larger events that may not fit into a market on close strategy, what do you suggest for benchmarks? Previous day's close obviously it seems to be industry standard, but the buy side, anytime they do a program, they're looking at arrival price. What say you?
What say you? So I think for any event that we do, we try to show every benchmark possible, right? So we show them all in the post trade. But in terms of the one that we are going to highlight, that's always got to be agreed upon prior to us trading, right? There has to be clear discussion in the pre-trade analysis that this is the benchmark that we're going to use and why. So for most two-sided, there's a separately managed account on both sides. We're going to really try to push the client to where we're using arrival. Now, what most investment managers are doing when they're sending, block trades or program trades, they're usually looking at arrival, but it's based on MBBO, So if you have a sell, you're being held to the bid at the time the order was received. If you've got a buy, flip side, you're looking at the best offer at the time it was received. But for any transition manager that is going to go out there and estimate a bid-ask spread, then if you do that and then you hold yourself to an arrival based on NBBO, then you have baked in basically a savings that really just benefits you as a transition manager. So we look at midpoint. Our bid-ask spread estimate is based on that as well. And then, if we're going to use arrival and you have to set a strike time. And so there's a discussion then on what is the best time to start an event. Right. And so we do a lot of work on showing historical bid-ask spread because spreads have gotten pretty large, especially at the beginning of the day. So, right, you're trying to weigh, I want to get as much of this done as possible, as early as possible, because opportunity cost risk is, definitely an item of concern. But at the same time, if you start too early, you're putting yourself behind the eight ball, really. So, if I looked at, going from large to mid to small to micro cap, I've done a study where you look at historical spreads, right? And just going from, say, 1 minute after the open to 10 minutes, after that point, you're seeing about a drop of anywhere between 33 and 47% of spreads from what they were at 1 minute after the open. So you really want to look at the individual portfolios that you're trading, look at the spreads, and then come up with the best time. And sometimes that could be an hour after the open, right? I would say the open is probably one of the worst benchmarks to use because positions open at different times of the day. And especially if you get into small caps, those times can be a lot different, right? Large caps are all going to open pretty much around the open. But for the small and micro cap positions, there might be 5 minutes, 10 minutes, 15 minutes delay before they even open. And then you're comparing yourself to this weird myriad of times across the board. So again, benchmarking is really, really important to discuss. The client just needs to have an understanding of what it is and why it is. And to be honest, it puts a lot of responsibility on the client maybe to get into some of those details that they may not have in the past. So don't just take whatever benchmark is given to you as you just want to assume that it's going to be right. I think there needs to be some digging as to why it is.
Carrie, in the post trade, what are you looking at?
Really, expectations. How did we do? How did we think we were going to do? How were conditions that day? Were there any kind of unexpected hiccups or events or developments? I think looking pre to post trade, how did things shake out and why?
The topic of transparency comes to mind when we're talking about post trades. Brian, what is it that you add to the post trade that you think adds to that sense of transparency, or is it just communication during event?
So, that page 2, right? The page 2 of the post trade of whoever it's with, right? There's a cover page, and then the next page is going to be how much did it cost? That's what everyone wants to know, and for good reason. It should then be compared to the pre-trade estimates that you provided. That should be a very clean comparison. Always apples to apples. There should be no benchmark changes of we estimated based on previous day's close for the pre-trade. We looked at market on close for the post trade. And so then from everything that is in a post trade for whatever transition manager is out there, what they're providing should be based on how do we tell the story of how we got to that number. Because as Carrie's mentioned, right, these are going to different levels of people who have different levels of sophistication on how they can interpret the items in there. So you have to keep that in mind when you're providing details, so that when it goes into their hand, they can understand what it is, or at least have the best chance to do that without having somebody right over their shoulder in their ear telling you what everything means. We also try to give transparency on, how much do we trade every 10-minute window. We show that graphically. we're trying to just put all of our cards on the table. And I think that's, in general for transition management, that is our job, right? Our job is to get somebody from A to B, reduce risk, and provide transparency. So at the end of the day, everything looks good. The post trade can be filed in a file, and clients and consultants can go on with all the other 99% of their job that isn't transition management.
And Carrie, you mentioned in the beginning, you mentioned the operational processes, right? The things that are important. As we look to wrap this up, what else would you emphasize is key in selecting transition management and a transition manager?
Yeah, so I say, in a relationship like this, as with many others, especially in financial services and market related roles, trust is key. You have to, feel confident that you're working with a partner who is a good communicator, who isn't afraid to kind of bring up issues that may arise and kind of be proactive in offering those solutions. I think somebody that, very thoughtfully kind of recommends an approach to a transition up front. If the outcome is different than expected, kind of setting expectations as to what happened, just being a very honest, kind of reliable, trustworthy partner is incredibly important in this space. Because again, not a lot of us, including, consultants, clients, are watching markets all day, are kind of performing the analytics and the benchmarking that you all do. So we really having a partner that is very trustworthy is incredibly important in this space. And I think some of that comes to too, admitting if things went a different way, why. There was a transition once that comes to mind. We were going active in one space to a different active manager in that same space. And through the day, kind of trying to maintain market exposures, one particular name in a sector, kind of went sky high, and we were kind of from a timing standpoint on the wrong side of that. That type of thing makes sense, but just understanding why, if kind of the trade goes differently than expected, what happens, and that honest communication, proactive communication, that clear partnering, and kind of putting the clients first is very important. I think when you're first starting to use a transition manager, maybe asking others for recommendations, who they've trusted, who they've had a good experience with. And then over time, you build up kind of your own experience with transition managers, and you kind of learn who you can count on, who has a great reputation, who delivers, but really trust. I mean, number one by far.
Well, I think that's really a great way to end our conversation. Brian, you have anything else you'd like to add before we wrap up?
Yeah, to trust the hardest thing to quantify, right?
Yes.
One of the biggest things we try to sell too, but I think trust is key. And I think the only thing we maybe didn't hit on is just the fixed income space. I think fixed income provides a little bit different of an animal, simply because the amount of electronic data that you can get on historical prints and pricing on bonds can be very difficult. So Carrie's mentioned the word expectation a lot. And so I think it's key for a transition manager to come in, and on the pre-trade analysis, we're really valuing up all of the fixed income positions. And sometimes that can be very eye-opening to see what they're actually worth in the marketplace versus what the custodian pricing matrix have them listed at. And so a transition manager can be very valuable in that space as well, to set expectations, not just on setting benchmarks or anything like that, but just how much is your portfolio actually worth? Because that leads to discussions about maybe positions that you hold to maturity, what you do trade, do you have limits on them? So I think that's just another space of transition management that's very different than maybe the typical domestic equity event that you would have. That's
sounds like you are foreshadowing episode 2 of transition management with Brian Gibbs. So we'll have to pick that topic up next time. I think we've used our 30 minutes here. I want to thank you both for joining us, and thank everybody who listened to this call. If you care to listen to it again or share it with others, you'll find it on capis.com. With that, thank you very much. Bye-bye.
Thank you.
Thank you.